The new year approaches with a promising outlook for jobs and economic growth, but also the promise of rising interest rates. Our thoughts on the year ahead with our central forecasts and the most likely risks to consider. "2021 was a year where the effectiveness of fiscal and monetary policy shone through, driving unemployment down to 4.5% and GDP growth a record 9.5% last financial year, before the Delta strain briefly deferred the recovery in the third quarter. Thanks to high vaccination rates and borders now reopening, the recovery has resumed, evidenced by strong retail activity, a rise in consumer sentiment, and a resumption in jobs growth. As a result, our baseline forecast is for Australia's unemployment rate to fall to 4% in 2022, and for these tight labour markets to help wages growth back to almost 3%. So, as we talked about in last month's update, demand appears assured in the months ahead. However, the challenge will be supply being able to keep up. As we're seeing all around the world, inflation and producer prices are at multi-decade highs, with supply chain bottlenecks, elevated energy prices, especially in Europe, and a rush for materials as economies reopen. In the US, the Consumer Price Index has just reached 6.8%, its highest level in 40 years, and core inflation is 4.9%. So the Federal Reserve has dropped the word transitory and are now describing inflation as persistent, and 3 US rate hikes are now expected next year. Fortunately, here our CPI is less than half the US rate, and we only have 2.1% core inflation. But next year, we do expect core measures to trend towards the top end of the 2 to 3% target band. The RBA have removed their references to 2024 rate hikes and are now simply saying they will be patient, waiting for full employment to drive wages and inflation higher. But if our forecast of 4% unemployment next year is met, this should pave the way for RBA rate hikes by late 2022 into early 23, although the market is even less patient than this, pricing in policy rate rises by mid-next year. As long as this fall in unemployment and rise in inflation is hand in hand with wages growth and economic growth, then our economy can cope with higher interest rates. And our base case is for GDP to grow between 5 and 6% next year. The obvious risk to this forecast comes from the Omicron strain of COVID-19. Assuming vaccines and boosters are effective for the new strain or any other mutations ahead, then the recovery should remain on track, as household balance sheets are, compared to 2019 levels, in a very strong position. The pandemic has been destructive to a range of industries and has been indiscriminate in its impact, but fiscal policy and record low interest rates have, on balance, driven a wealth effect that will shape the 2022 recovery. Property prices continue to rise, not helping affordability, but helping consumer sentiment and business confidence. In summary, the outlook for next year is one of strong household demand, strong demand for labour, and firm commodity prices, all of which should see our economy maintain its resilience and its outperformance. The two most likely spoilers ahead might be inflation running ahead of RBA expectations, pushing interest rates higher sooner, or conversely, the Omicron strain delaying the reopening of borders. For the moment, 2022 has the promise of solid growth and demand, but a recognition of these upside and downside risks. And that's the market update from Bendigo Bank, with best wishes for the holiday season.